All right, guys, you ready for end of the review and the start of the exciting stuff? Yeah, so I got to make sure that you're up to date on this stuff. So we don't have to have class today if everybody can tell me all the elements of both types of reports. If you guys can just list those off right at the top of your head without looking at your computers. You feel like you got it, Matt?
Yeah, I've been doing Becker for a while.
Oh,
So,
okay.
let's see. So for a non-issuer, let's see, you have your objectives paragraph. And then sometimes you need an emphasis of matter, but you don't always need an emphasis of matter paragraph. Then you have the auditor's responsibilities, management's responsibilities. They don't call it critical audit matters, they call it key audit matters, but you don't always need key audit matters unless there was something that was difficult to audit, but it turned out fine in the end.
Yeah, I forgot a few things, but that's actually really impressive. That's like, considering that I just kind of threw that at you. So yeah, guys almost got out of it. You know, Matt nearly called my bluff, but I'm going to be technical on it. I don't know. Dr. Caden was here just at the beginning, and she was kind of suggesting that I make you all memorize the audit reports. What do you guys think? Does that seem fair? Just throw that on the quiz and just regurgitate both reports, the PCOB and the ASB audit reports. Actually, PCOB probably wouldn't be that bad. I think you all would go into riot mode if I made you memorize the ASB audit report. So yeah, that's something I'm not going to do. All right, let's go ahead and get to engagement completion, and then we'll get out of here. Okay, hopefully we'll have a better idea of what we need to be doing. So we're done with the audit. We have finished our testing, finished our controls testing, finished the substantive testing. We need to conclude the audit. So there's obviously the issuance of the reports, which provides our opinion on the audit. But what is it that we need to do before that to kind of wrap up the audit? It'll be our concluding steps. So a few of these should be in memory. The reason I bring these up, these tend to come up quite a bit frequently when we're talking about concluding audits. These are steps that kind of take place in every single audit. So just make sure that we have touch base on all these, make sure we're familiar with them. So we're going to review for contingent liabilities and commitments. So you guys remember contingent liabilities back from 303? Say I'm telling you about auditing and saying it wasn't that a long time ago. 303 was probably even longer ago. Depending on when you took 303, Dr. Shanawa did or did not have hair. You know, it really depends on what semester you took it in. And so some of you may be looking back 2-3 years back and saying, okay, I remember the shaved head Dr. Shanawa. That was a sight to behold, by the way. You know, I wish I still had pictures of it, because some of you may believe this mythical beast did not actually exist, but it did. I promise you, it did. Anyway, remember contingent liabilities. Contingent liabilities are characterized by an event that there's a liability that's expected to occur at some point in the future. And so it has to be probable and reasonably estimable. And those are the GAAP rules. They're probably not going to test you too much on that in auditing. That being said, it's surprising how many times in auditing I find financial accounting stuff comes up. So we do want to reflect upon that. What are our responsibilities as auditor? Well, we want to make sure we understand whether or not these contingent liabilities, and to a lesser extent commitments. Remember, commitments, those are our requirements or an obligation to purchase something at an agreed upon price at some point in the future. We want to make sure that those are properly treated in the financial statements. And so one of our goals as auditors is to identify any contingent liabilities or commitments that may exist, and that should ensure that the ones that do exist and we've had identified are properly treated. One of our primary mechanisms for this is going to be obtaining a legal letter. Now, that's a letter to the attorneys basically saying, here's everything we know about. Can you confirm this? I would like to reiterate, this is something that's a really important point. When we reach out to the attorneys are never going to volunteer information to us, because you may say they're dirty attorneys. And I had dinner with Dr. Templeton last night, or Prince Templeton last night. And it's true, you know, they are kind of devious individuals. I wouldn't say that just because of dinner. It was, he was devious. He was talking about his strategy about how he was going to eat half of his dinner and then he was going to take half of it home so he'd have a nice lunch today. So if anybody sees him before lunch, you can say, how's the chicken fried steak or chicken fried chicken, Professor Templeton? And he's going to say, where'd you hear that? Where'd you hear that? And he's going to say, that was from the devious Professor Barnes. And so, I'm rambling today, guys. Sorry. What is it? The whole goal about this is that if we reach out to the lawyer, they represent the client. They represent the client, not us. So if we say, tell us everything you know, they're going to say, all right, we don't know anything. because they're not going to volunteer any information. But if we ask them to talk about that information that we know about, that we're aware of, they do have an obligation to disclose that because that's information that's already been, or information that's already been provided by the client. So it's a good means of gaining confirming evidence about information we already know, but you can't actually identify any new information in this process. Then we have subsequent events. So subsequent events, remember, subsequent events are those types of events that occur after the balance sheet date, but before the issuance of the financial statement. All right, so what happens if that occurs? Well, there's a couple of things we need to know. First of all, we need to understand what is the nature of the subsequent event, whether it's a type 1 subsequent event or type 2 subsequent event. So what's the difference? Type 1 subsequent event is something that the conditions existed as of the balance sheet date. Okay. Type 2 subsequent event is something that occurred after the balance sheet date and no conditions existed. Easy way to think about this: type 1 subsequent event is a lawsuit. Okay. Conditions existed as of the balance sheet date. Type 2 subsequent event would be a natural disaster. All right. Something that was just something that came out of the blue. Now, that's not a limitation of subsequent events. Those are not the only types of subsequent events we have, but those are going to be an easy way to think about the different types. So conditions did or did not exist at the balance sheet date. Okay. Now, what are the requirements for subsequent events? If we're talking about a type 1 subsequent event, it is always going to be something that requires restatement to the financials. So think about this logically. There's a lawsuit that's pending. It's a contingent liability. It gets settled before the financial statements are issued, before the balance sheet, or before the financial statements are issued by the client. We as auditors are going to say, well, you know, the resolution of this this settlement, you need to record that settlement in the financial statements, which makes sense because it was a pending liability. Now we know what the actual liability is. So type 1 events are always restated. They're always reflected in the prior period financials, right? Type 2 events. Type 2 events at minimum are going to require disclosure in the financials. Now remember, type 2 events are something that we did not know about as of the balance sheet date. So there's something brand new that comes up. They're still important to stakeholders. They would want to know about them in the annual report, but they took place after the period end. So minimum disclosure. So something that's very, very significant, if we're talking about something really large, like a really significant natural disaster destroyed like a factory or something like that, that would affect operations considerably, then we may also have to insist that the client prepare pro forma financial statements. So remember those pro forma financial statements, those are forward-looking financial statements based on representations made by management. Those are kind of a unique scenario that basically say, what is the impact of this particular event that occurred? Now, what are the auditor's options in this scenario when the subsequent event comes up? And that really depends on what the timing of the event is. If an event occurs before the auditor issued there's a report, then we're just going to be concerned with this information right here about whether or not it's type 1 or type 2, and then we're going to affect how it's affected. But what happens if the event occurs after the auditor issues their report, but before the client issues the financial statements? And that's rare that it happens in public company audits anymore, but it could occur in a private company audit. What is the auditor's responsibility? Well, the auditor does have responsibility for that subsequent event at the very minimum. But they've got two possibilities of the way they can approach it. They can actually say that they're going to dual date their report. The dual dating says that we're going to test everything through the issue or the date of the testing for that subsequent event. So say a subsequent event occurs after the auditor's report. They have to do some testing on that event to figure out what is going to be the nature of it. And that testing takes them a week. They would have a new audit report date, which would be a week after the subsequent event occurred. All right. That would be an example of dual dating. They have one date for the report and another date for the testing for this one singular event. The other possibility is that they test the event and they extend their audit report out to exactly that date they finished testing. That's saying that they're responsible for all events that occurred up to that date. Okay. There's an example of this. I believe there's an example of this in the first CPA prep assignment that you'll want to walk through that talks about the nature of subsequent events. But basically what we're looking for is we're trying to determine if it's dual dating, it limits the liability. If they change the audit report date, that's extending the liability. So additional steps: performance of final analytical procedures. Remember, analytical procedures are performed at 3 stages: preliminary, substantive, final. Final analytical procedures is our wrap-up. This is just to make sure everything looks reasonable. All right. If anything seems out of sync, want to investigate and understand that. We're never going to obtain a management representation letter. Does everybody remember the management representation letter? It was the weird letter that occurred. The auditor writes the letter, but it's written like it's written from management. The reason why is it's basically auditor writes a letter, management, it's management's representation about everything, all the information that was provided, all the services that was rendered over the course of the audit. Why does the auditor write it? Because they're the ones who document all this information. So management just basically reviews it, says this looks good and signs it. It's signed and addressed from the management to the auditor, again, which is weird because the auditor actually writes it. Review of the working papers. This usually occurs by a partner on the engagement. Okay, this is kind of the first overall review. We also want to evaluate the audit results. We want to make sure we understand what is the nature or what is the nature of the opinion that we issued. Is that consistent with the documentation that was provided? We also want to evaluate kind of the client's financial statement presentation and disclosure to make sure that's consistent with what expectations are for public company audits. We said that's generally accepted accounting principles, but that could be whatever the reporting criteria is. Then we're going to obtain an independent review of the engagement. Now, how does this differ from the review of the working papers that occurred up here? This is usually the engagement partner. This down here is going to usually be a partner who's not on the engagement, who's not associated with the engagement. So this is going to be an independent review. If we're talking about a particularly small firm, like say we have a firm with one partner, we can't engage an outside firm to perform this review. They can do the review. The idea being is we want to bring somebody in who's not involved in the engagement to review the working papers, to review everything that was performed, and make sure that what was performed is intuitively sensible, that it makes sense, that it follows the guidelines that we've set. And then we're going to evaluate the entity's ability to continue as a going concern, which I believe we're going to talk about that next. Okay. So going concern, what does that mean? Basically, going concern is a good thing. If we have a going concern, it means they're going to exist. I would like to be a going concern for at least the next 30 years. Okay, that's my goal in life. All right. Yeah, that's my hope. You know, I say that now. You never know. You know, things may change. I may say 40 years. I may say 50 years. I may do like that one guy who's trying to strive for immortality online. I don't remember what his name is, but the tech billionaire who's spending $2 million a year to be immortal. I don't know that I want to go that far, mostly because I don't have that kind of money. But I would love to be a going concern for the immediate future. But oftentimes when we're on the engagement, we're going to look at the financials and we're going to say, hey, the way they're reporting looks good, but I have some serious concerns about their longevity. They may not be in business a year from now. This happened a lot during the COVID pandemic. There were some concerns in this area. So when an auditor encounters this is considered to be substantial doubt about the entity's ability to continue as a going concern. There's going to be a three-step process. So first of all, answer the question. Is there substantial doubt about the entity's ability to continue as a going concern? If the answer is no, then we can just move on with our audit and our lives, all right? But if the answer is yes, we're going to go talk to management. We're going to say, hey, what are your plans? You got to fix this problem, otherwise your company's not going to be in business. If we talk to management and we say, all right, they're aware of the issue, and I'm satisfied with their ability to solve this problem, we can again move on. But if we're still concerned, if we still think substantial doubt exists, then we need to add an explanatory paragraph to the audit report. Now, there's a couple of things I want to add on here that are really important. First of all, this is not going to affect the opinion that we render. The going concern statement does not actually change the opinion. Basically, we're saying the financial statements indicates that there's problems with their ability to continue unimpeded with their business model. But we're not trying to make any assessments independently about what their reporting looks like. Okay, whatever their reporting is what it is. They can still have an unqualified opinion with a going concern paragraph. Now, that being said, something that's not on here is the auditor still has to make sure that if there is substantial doubt about the entity's ability to continue as a going concern, the client has to disclose that in their financial statements. Okay, they have to disclose this going concern issue. If they fail to do so, that is a violation of GAAP. That is a departure from GAAP. That would change the opinion rendered, okay? But that is more about that the client fails to disclose this information, not that this situation exists, okay? So it's important to make that distinction because it does come up. You do need to be able to delineate between the two scenarios. All right, what are the communications? So the audit committee, audit responsibilities and scope of engagement need to be communicated, but we need to have the overview of the audit strategy. And then we also need to communicate significant deficiencies and material weaknesses in internal controls or financial reporting, as we talked about last Friday, excuse me. Management needs to know about all control deficiencies. They get a report about that. It's also important to note that even though we don't communicate all control deficiencies to the audit committee, we do tell the audit committee when we've communicated to management these control deficiencies. They also need to know all significant deficiencies and material weaknesses in internal controls or financial reporting. And then we also are going to issue a management letter. Now, this sure sounds like management representation letter. There's a reason I don't use the same words. This is a different letter. This letter is basically from the auditor to the client with any recommendations about operations and controls that they might have. All right. Now, last thing, we finished the audit. We're on a beach and let's do Tahiti this time because Hawaii's still last year. All right, so we're on the beach in Tahiti and we're just sipping a cocktail and the client contacts us and say, hey, you remember I told you everything on the audit was okay? He says, yeah. Says, yeah, there was something I forgot to tell you. It has a material effect on the financial statements. The immediately reaction is, okay, get up, pack up our hotel, get on the plane, fly to the client, say, all right, here, let's fix the problem, okay? If something comes up and you go in and the client, and you believe it was unintentional, the client was not misreporting, okay, then you do have an opportunity to do an interim assessment and fix the issue, all right? And if that's the case, that's fine, okay? You just fix it, all right? Fix the problem. But what if the client has a misrepresentation in their financial statements? It was not deliberate, but they do not want you to correct it. So they misrepresented something unintentionally. Then you go in and say, I'm here to fix it. They say, we'd rather you not. We're really happy with the way that our audit went, okay? That is where things become problematic. That's where things become an issue. Because the audit report was based on information that's incomplete, information that was not, or the information that you need to finish the audit was not available to you. They can no longer use the audit report. The audit report is no longer viable. It was based on incorrect and inaccurate information. So you're going to tell the client, here's the deal. You don't let me perform the audit, then I'm not going to, we're not going to let you issue or use the audit report. That happens, that's when you're going to reach out to regulatory groups. If it's a public company audit, this is going to be the SEC. If it's a private company audit, there may be no regulator. It really depends. But we're going to reach out to any appropriate regulators. Then we're going to contact anybody that we know that relies on the financial statements. Now, usually the second step in a public company audit is sufficient to accomplish the third step. Because if you contact the SEC is going to make everybody else know. And so that's when the panic occurs. When we're talking private company audits, if it's something like a bank or as a specific group of stakeholders, that's when you have a responsibility as the auditor to contact them. All right. Just realized that my window up here is open. I'm usually better about closing that. There we go. Isn't that better, guys? Okay. Yeah, you guys don't have to look at me twice. All right. Here we go. Audit reports. So here's the deal. I recommend that you print out all the audit report documents on this bright space. We're going to be referring to these as you go through the section. If you don't have printed out, that's fine. These are available on Brightspace. I will tell you right now, the way that things are working right now, I'm trying to get a set of examples for the audit reports, for the ASB reports. The ASB reports are a little bit nightmarish in their scope. They cover a lot of ground. I was joking with Dr. Caden about how memorizing the audit reports, the ASB audit report, I think it's possible to memorize that. I don't know it's worthwhile. There's a lot to it. So here's what we're going to do. Is that we're going to work through both types of audit reports. We're going to talk about the sections, and then we're going to review those sections. And then we're going to cover those, and then we're going to do some referential review of each of these with respect to what it is that you need to know with respect to how these reports change in different circumstances, okay? So let's start out with the one that we know, because this is the one that we learned back in 417. This is a Public Company Accounting Oversight Board Standard Unqualified Report. This is our clean opinion, all right? So what do we start out with? We got a report title, okay? Then once we issue the report title, we've got our addressee. Then we've got the auditor's opinion, because remember, just like any good auditor, we'd like to spoil the conclusion before it's reached. That was always my problem. In the previous audit reports, the conclusion was always at the end of the report, which is like a really good book. You just kind of wait in the climax, building up, and then let it to you. And then now it's not like that. It's just like, okay, we're spoiling everything now. The auditor's opinion has been rendered. Then we got the basis for opinion, okay? For the basis for opinion. Now, I do want to note here, the basis for opinion is the next section, and it's a little bit simplified because it actually constitutes 2 paragraphs with 3 different parts, all right? And the reason I make this distinction is because we want to compare and contrast this to what happens in the ASB report here in just a second. These parts are all prominent in both reports. So we first of all, in the first paragraph of the basis of opinion section, we got 1 sentence on management's responsibility, okay? I believe the sentence is something like management is responsible for the preparation and fair presentation of the financial statements. Something along those lines, all right? Then we've got auditor's responsibility, okay? Auditor's responsibility. That one is a little bit more detailed. That's the rest of the second, or the rest of the first paragraph that talks about the different things the auditor is responsible for. Then we have something called the scope paragraph. This is details all of the work the auditor performs in a standard engagement. Remember, we talked about scope limitation as one of our criteria for opinions. Scope limitation implies that we weren't able to do something that was listed in this paragraph. We were not able to do our job. This details at a very general level what our job is. Okay, then is something Matt alluded to just a little while ago. For public company audits, we have something called critical audit matters. Okay, there's actually 3 criteria. We're going to look at those criteria here in just a second about what constitutes a critical audit matter. And then the name and signature of the auditor. Something that's unique to this report is going to be auditor tenure. And so auditor tenure is saying that how long the client has been, or the auditor has been engaged to work on the client. And then we have the location and audit report date. All right. So let's go ahead and take a look at this. And this, again, this should look familiar because we talked about this back in 417. I actually have a Word document that I've used for this, the PCOB audit report. Make sure that we go through each of these steps really quickly and make sure we can identify everything that's going on here, okay? So, as I said before, PCOB report, we got the report title up here, Report of Independent Registered Public Accounting Firm. We got the addressee. This is an interesting one. The addressee in this particular scenario says the shareholders and the board of directors are Ruthware Clothiers. And for most of our public company audits, that's going to be the groups that we're looking at, the shareholders and board of directors. That does not mean that every audit report is limited to that group of addressees, especially when we talk about private company audits. These could be anybody who's engaged in audit. So like if a bank engages an auditor to do a audit to make sure that they can issue a loan to a particular client, our addressee would be the bank. All right. So whoever actually initiated the audit is going to be the addressee here. Then we have the opinion, okay, and it's an unqualified opinion. So we know that it's going to say the financial statements present fairly in all material respects the financial position of the company as of December, blah, 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 whatever the date is going to be. Then we've got the basis for opinion section. By the way, down here, this is where the explanatory paragraphs can come in. We've actually got an explanatory paragraph all here. This is going to be the default paragraph on internal controls or financial reporting, which we're not going to go too much into, but these are usually going to be present in some capacity in these reports as well. Then we got the basis for opinion. These financial statements are the responsibility of company's management. So I was wrong. It's actually this financial statements are responsibility of company's management. It doesn't even say financial or management has a responsibility for fair presentation and preparation. So yeah, that's the problem with getting old is you forget really simple statements like that. But then everything else in this paragraph, this is the audit responsibility section, auditor responsibility. And this big long morass here, this is the scope paragraph. This is the scope we're looking at. I would make sure, even if you're not planning on memorizing this, which again, I'm not going to judge you if you don't, because there's a lot of information here. I would make sure that at least have a good understanding of the contents of the scope paragraph, as there's a very specific language that's listed in there. Then we have critical audit matters. Now I said there were 3 criteria for critical audit matters, and you may notice here that it actually only has 1, 2. There's actually a hidden 3rd criteria, and that occurs before this, okay? So these are matters arising from the current period of audit of financial statements that were communicated or required to be communicated to the audit committee. That is our first criteria. So it has to be current period that relates to or needs to be communicated to the audit committee. Then they relate to accounts or disclosures that are material to the financial statements. So it has to be material, okay, or the accounts themselves have to be material, and involve challenging, subjective, or complex judgments. So basically, it's a lot of subjectivity or complexity in the matter. These are basically going to be identification of areas that are of particular prominence in the audit, and they're listed out here on the left-hand side, and the auditor dictates what their responsibilities are, what their responses were to these particular issues. So usually this is going to be detailed out to some degree, and then there's going to be a big, long, detailed list of what the auditor did in response to that. This is not going to be every issue in the audit, not by any stretch of the imagination. For the most part, the PCOB reports usually report somewhere 2 to 3 of these in a given scenario, and I think that's probably sufficient. These are going to be the big picture issues that are most important to the audit itself. Okay, then those are the 3 criteria that you need to be aware of. So here's the name and signature of the auditor, here's the auditor tenure statement, and here's the location and the report date. Okay, so that one should feel pretty familiar. Now the good news is what we're going to be looking at for the next audit report is not going to be that much different. It's going to look a lot different, but the basic information is the same. Now, this is going to be the ASB report. Now, just for context, this is what the ASB report used to look like, okay? very simple and straightforward. It just kind of was very, very simple. This is before 2021. You don't need to know this, by the way. I just kind of like show you. This is my proof that ASB hates accounting students, okay? The EICPA hates accounting students because now we're going to be dealing with this monstrosity right here, okay? Yeah, that's basically what we're looking at right here. So we're going to talk a little bit about what's going on in this report. So from basically a page of information to what was now 3 pages of information in a PDF form. So just for context, I didn't provide a document on this. I actually provided the actual statement on auditing standards. It's on Brightspace. It's SAS 134. There's some illustration examples. We're going to be looking at illustration 2 in paragraph A81. And we'll talk about what the elements of that are here in just a second. So moving on. Oh, let's get past this. So this is a standard unmodified report. Remember, for clean opinions in this scenario, we actually use the words unmodified, not unqualified. Does it mean anything different? No. Okay. Exactly the same thing. Just again, the AICPA saying we're just going to be different, just to be contrary. So yeah. And then they're sticking their tongue out at the PCOB for some reason. All right. So what is going to be included in this particular item? All right. The report title, the addressee. So we're pretty much on same ground. Title, addressee, same as the PCOB report. The auditor's opinion now occurs at the beginning, which is one of the things I liked about the old ASB report. The opinion was at the end, but they say it's so important that it goes at the beginning now. So it's very consistent with the PCOB report. So organization is still consistent at the beginning. Then we have the basis for opinion section. I want to make note when we talk about basis for opinion, this basically constitutes the scope paragraph in this report. The reason why is because in the basis of opinion for the PCOB report, there were three parts: manager's responsibility, auditor's responsibility, and scope. And as we're going to see here in just a second, auditor's responsibility and manager's responsibility are actually separate paragraphs in this particular report. So this is just effectively the scope area. Then we have key audit matters, which are basically critical audit matters. Now you may say this sounds like that they've got an imitation complex. The funny story behind this is critical audit matters are actually imitation of what the IASB did several years before that. So IASB had key audit matters. Then the PCOB said, we're going to do critical audit matters. And then the ASB, the ACCT said, we're going back to key audit matters because we want to do like our international brethren did. But they're effectively the same thing. The big difference is that for key audit matters, they don't specify the audit committee. They do specify those charged with governance, which makes sense because if we're talking about private company audits, the organizations may not actually have audit committees. Okay, so that's why there's a specification there. Then we have manager's responsibility that occurs after the critical audit matters, or key audit matters, I guess I should probably say. CAMs or CAMs, I'm sorry. I should say CAMs with a K instead of CAMs with a C. All right. All right. And then auditor's responsibility. Now, here's where some things go a little bit awry. For the most part, this is consistent with our PCOB reports, which is good. And interestingly enough, the language is not all that different either. Now, where things start getting awry is when we start getting the new sections, okay? These are sections that are somewhat new. Oh, also, as Matt alluded to, key audit matters are not required for every ASB report. This is an optional section, whereas in the PCOB report, critical audit matters are required for every unqualified report issuance, okay? So they're basically effectively required for PCOB. For ASB, these are optional if the auditor decides to report on key audit matters, all right? So, or if they're engaged to report on key audit matters, I guess you could probably say more effectively. So then we have a section called other information. Now this is another optional section, but this is just it's information that's not qualified as key audit matters, but is something the auditor wants to share with respect to the report. Keep in mind, this is not the same thing as like an explanatory paragraph or explanatory language sections. There's actually a different terminology for that, which we'll get into. But explanatory language sections, this is actually just saying any additional information that we think is relevant to the audit but doesn't qualify as a key audit matter. Then we also have a report on legal and regulatory requirements. This is kind of a nasty section that's unique to this particular area. It talks about compliance issues with respect to that. To my knowledge, this is a required section. I'm not seeing any reports that do not include this section, but it can vary in complexity. It can be very simple or very complex. Then we have name and signature of the auditor and the location and audit report date. So you'll notice there's no tenure statement in this particular report. That's not required in the ASB section. But we do have these two new sections that pop up, other information and report on other legal and regulatory requirements. All right, let's go ahead and take a look and see examples of this, okay? So again, we've got a report titled Independent Auditor's Report, and that's pretty straightforward to the point, okay? Then we've got our addressee. Then we've got our opinion section, and the opinion section is going to be fairly consistent with what we find before. Financial statements fairly in all material respects the financial position of the company, which is almost exactly the vernacular that was used in the PCOB report. The basis of our opinion, as I said, this is effectively the scope paragraph. It's not as detailed as the PCOB scope paragraph, but it effectively does the same, accomplishes the same thing. Then we have our key audit matters that are listed out here that are listed. The reason this is illustration 2 in the report, and I focused on this, illustration 1 is an example without key audit matters. So that's kind of a reinforcement of the fact that they are optional. They're not required to be included. The responsibilities of management of the financial statement. This is interesting because in the PCOB report, it was one sentence, okay? And it said the financial statements are the responsibility of management. This one is 2 whole paragraphs. Talks about the details of management responsibility, as well as some optional language with a time period for the reporting framework. And then auditor's responsibility is listed out here. It's important to note here that even though we talked about the scope paragraph, they go into a little bit more detail with respect to scope in the auditor's responsibility section, particularly their responsibilities in accordance with generally accepted auditing standards, which is more about quality of the administration of the engagement than the actual the engagement itself. So this one's actually a pretty long section. I do want to reiterate my point on this one. With respect to audit responsibility and scope, I do encourage you not to necessarily memorize this, but please make sure you're familiar with the language in here because there is some very specific language that's used in this area. But yeah, there's a lot going on in this particular section. So this one is probably the most intimidating part of this particular report. You will notice other information has been left out of this example report. It would normally occur right here if we had other information, but it's not a required section. There's a report on legal and regulatory requirements, and it says the form and content of the section will vary depending on the nature of other auditors and other reporting responsibilities. Again, that's consistent with what I said about the various and complexity. Then we have signature of the firm, the city and state, location, and the date. Okay, so city or signature, name and signature, location, and our report date are all listed here. So yeah, a lot going on. And the good news is we've got a lot more to talk about because that was just the clean opinions. Okay, those are just the clean opinions. So I don't want to intimidate you. We're going to talk about some variations on these reports. I would say focus on learning these 2 formats of the reports. That would be the most important thing, simply because that's going to get you a long way to understanding what you need to know for the other sections. All right. So moving back, let's get this all popped up. Okay. Moving back here, we now have an idea of what our clean opinions look like. What are some things that we need to be aware of? So the very first thing we need to understand is what happens when we add explanatory language. So before I move on, and I don't want to forget this because I want to throw this out here, okay? Where it says explanatory paragraph, I want you to go ahead and make a note. This particular term right here, this is unique to the PCAOB, all right? When the ASB or the ACCT, I should say, when the ACCT reports want to add explanatory language, they refer to that as an emphasis of matter paragraph or an other matter paragraph. So emphasis of matter or other matter. And the criteria for their usage is a little bit, is not particularly important to understand the distinction between those 2 types of paragraphs. What's more important is understand when are the scenarios that you use explanatory language. But they do not talk about it as explanatory paragraphs. They call it emphasis of matter. And again, this is going to come up in your review. You're going to say emphasis of matter paragraph. What is that again? Oh yeah, it's effectively explanatory paragraph. Okay. So when you talk about scenarios that we would use explanatory language. All right. So the first scenario is basically we are going to modify the wording in the report. And the reason this is an important distinction is because when we talk about explanatory paragraphs or emphasis of matter paragraphs or other matter paragraphs, they do not modify the standard wording of the report. They just add wording to the existing report. Modified wording says we are going to change the wording in the report without changing the opinion being issued. And it only really occurs in one scenario. And that's going to be when we have an opinion based in part on the report of another auditor. So we've got a large audit engagement. We had to hire a secondary auditor to handle certain parts of it, maybe a subsidiary, maybe a separate location. We as the primary auditor have reviewed their work and we say we believe their work is good, but we are not willing to take responsibility for their work. Now, that's an important distinction to make. If we as the primary auditor say we are willing to take responsibility, then this is irrelevant. We don't need to worry about it. But if we're not willing to take responsibility, okay, we're not willing to take responsibility. So Kirsten's the primary auditor, I'm the secondary auditor. Okay, she reviews my work and says, you know, Dr. Barnes is okay, but I don't trust him. Okay, she's going to say, all right, I am not willing to take responsibility for her work. So she's going to say, based on our work and the work of the other auditors. So based on our work and the work of the other auditors, that's really the only important distinction language. So she's leaving the distinction open to say, I was not the only one who did work on this. So if there's a problem, it can be based on work I did, or it can be based on work somebody else did. That's a litigation concern, because if something happens, if there's a litigation that comes up, of course, the audit, if you take responsibility for the entire audit, guess who's responsible for the litigation? Yeah, you are, okay? That might be a reason why you want to make the distinction based on the work of another auditor. The areas that this gets affected is in the opinion paragraph, the basis for opinion paragraph, and then in PCAOB reports, generally there requires an additional explanatory paragraph to be added. So far as I understand, this is not true in ASB reports, but I'll be honest, I have not looked at enough ASB reports with this type of manipulation, so you'll know if that's true. Just know for right now, when we talk about modified wording, generally we do have to modify the language, and the language modification is just as I said, based on our work and the report work of other auditors. Explanatory paragraphs, or as I said, emphasis of matter paragraphs or other matter paragraphs, those are a little bit more straightforward. These are just additional paragraphs that get added in certain situations. Some of these you already know, the ICOFR report, okay? So if we perform an integrated audit, we're going to issue an opinion on the internal controls over financial reporting. The fact that we are performing that audit gets included in the financial statement audit report. So we add that explanatory paragraph. We also add it for going concern issues. If there's substantial doubt about the issue, it needs the ability to continue as a going concern. Again, this is just the existence of substantial doubt. This is not attesting to whether or not they properly disclosed it. That's a separate issue. If there's a lack of consistency, I want you to make a note of this when we talk about consistency, because this one's one that comes up a lot when preparing for the CPA exam, okay? When we talk about this needs to be probably better the terminology that better to be used here is comparability. It affects comparability. If it affects comparability from one period to the next, it is likely to require an explanatory paragraph. And this will come up during your homework because I've already looked at some of the questions that are assigned here. Be very, very aware if you're looking at consistency, you're trying to determine is the one period comparable to the next. If the answer is yes, then we don't need to worry about the explanatory paragraph. This would be like a simple modification, like a change in the accounting estimate. That's not a major change in accounting estimate. Like we change the useful life from 4 years to 5 on a depreciable asset, something like that, okay? If it does affect comparability, if it's a material effect of comparability, it doesn't really matter what the accounting change is. If it does affect comparability, then we will have to report this in the explanatory paragraph. And the reason this comes up is because a lot of times when you see this on the CPA exam, they will say a change in accounting estimate is treated the same way it's treated for financial reporting purposes. You remember change in accounting estimate is treated for prospectively. Okay, we don't have to worry about doing retrospective adjustments or retroactive adjustments to the financial statements. Generally speaking, there's no further additional treatment, and that's true for audit reports. But they do throw a caveat on there. If it's big enough to change the comparability from one period to the next, then it would require no matter what the nature of the treatment is. So keep an eye out for that as you're doing your preparation. If it does affect comparability, that's a really important concern. And then anything that we feel requires additional emphasis. This is basically our catch-all for anything else that we think might be important that we need to note in the audit report. So basically, these 3 concerns and then everything else, you know, which is kind of like I always don't like it when they say, all right, what is everything else that we did capture? And they're just going to say basically everything else. This is just basically saying anything else we forgot above. Yeah, that's kind of cheesy. Okay, so we've got our unqualified report. We got our unqualified opinions. That's we've got there. So the good news is that we've got 2 of our reports down, or sorry, 1 of our reports down. We only have 4 other report types to go. Okay. The bad news is we've got 7 minutes. Okay, so I don't really have time to go through each one by point. So I do want to talk really quickly about these, what you should expect to see. The good news is that generally speaking, you're going to be looking for the same adjustments. So when we talk about how the changes occur, when we talk about qualified opinions, adverse opinions, for disclaimer opinions, there's going to be a pretty consistent series of changes we need to be aware of. Now, this is not comprehensive. I would not say, when sit in this class and listen to me talk over the next 7 minutes, you should not feel like, okay, I'm ready to tackle this part of the CPA exam, okay? I still encourage you to prepare and understand this, but this should be a good rule of thumb for you to use to think about this, okay? So let's talk about qualified opinions first. Remember, qualified opinions can come up one of two ways. They can come up from a departure from GAAP or a scope limitation. Departure from GAAP is our client didn't follow the rules. Scope limitation is we couldn't do our job, all right? I'm assuming everybody remembers that from 417. It's pretty straightforward. Qualified opinion is something that's material, but not pervasive. All right, so material effect, but not pervasive effect. What are the two words that generally we look for in a qualified report? Does anybody remember? Except for, we're looking for the words except for. Yeah, and then so the term except for is going to be the issue. So the reason this is important is this is going to require a modification to the opinion section. And the specific modification we're looking for is except for, and then whatever the issue is, the financial statements are free of material misstatement. So that except for statement is going to be our modification of the opinion paragraph. The other thing that you're looking for in the reports, and this is again consistent for both the ASB and the PCAB report. By the way, I want to reiterate, these terminologies are consistent now for both types of reports. We don't have, remember I said that it's unqualified for PCAB and unmodified for ASB. All right, that's the only difference. For some odd reason, when we get to the other types of opinions, they're all exactly the same terminology. So we have a qualified opinion that's true for both ASB and PCAB. We have an adverse opinion, both ASB and PSB. There's no distinction between those. The only thing that has a different terminology are going to be the clean opinions, modified and unqualified. So qualified opinion, we're going to change our opinion paragraph, and then we're going to add a paragraph to the basis of our opinion to explain the nature of the opinion, the nature of the change in opinion. So we got to add a paragraph and say, all right, here's the reason that we can't issue a fully unmodified / unqualified opinion. It's because this issue came up and this issue had a material effect of X dollars, and we just thought you should be aware of it. This actually goes into the audit report. That's going to be true for both qualified opinion departure from GAAP, qualified opinion for scope limitation. Now, what about adverse opinion? Adverse opinion, that's where we say the financial statements are materially misstated. Or probably more appropriately, the financial statements are not free from material misstatement. Wouldn't that just be easier to say the financial statements are materially misstated? You know, I don't like double negatives, okay? I don't like double negatives. Never not use a double negative. No, that doesn't work. Yeah, so financial statements are not free from material misstatement. Financial statements are not free from material misstatement. So that's going to be the first change, a change in the opinion paragraph. We also have to add a basis for opinion, add a paragraph to the basis for opinion section that says, here's the reason that we've got an adverse opinion. Also, it's important to note, this is going to be true for all of our extreme opinions. Our CAMs, CAMs, and KAMs get removed whenever we have extreme opinions. So if we have an adverse opinion, we don't have a critical audit matter section or a key audit matter section. And the reason why is pretty apparent. If you're issuing an opinion and it's an extreme opinion, that is your audit matter. That is your critical / key audit matter that you're identifying in your basis for opinion. There's no need to go any further beyond that. That is what dictated the course of the scope of the audit, or the conclusion of the audit, I should say. All right. Those are pretty straightforward. Those changes are not particularly difficult. Again, review those reports. Now, I do want to throw in the last one here, the disclaimer of opinion. Disclaimer of opinion, traditionally speaking, is the most challenging of the formats of the audit reports. The reason why is because there's a lot of information in the audit report that says, here's what we did as the auditor. When you disclaim an opinion, the reason you do that in most situations is going to be you could not do that work. So if you're talking about the information that's in a report, you're trying to say, all right, here is what we were supposed to do, but we couldn't do it. So a lot of times the language is going to change to reflect the fact that you tried to do something, but couldn't do it. Now, I'm not going to go over all the details of the changes, but there are some pretty consistent ones that you can look for. The same changes that extreme opinions exist. So change to the opinion section, addition of the additional statement of paragraph in the basis for opinion section, the elimination of CAMs, KAMs, and CAMs. Those exist. Also, in the PCLB report, and I think it's probably true to some degree in the ASB report, we eliminate the scope paragraph. Why is that the case? Why would we eliminate scope? Because we couldn't do our job, so we're not going to list the things that we did over the course of the audit. Again, the important thing here to remember is that we're looking for change in terminology of anything that says, here is what we did. Because in a disclaimer opinion, we could not do that work. That's the case. There's also one other, and I don't think this will come up in your reports. I don't think you'll have to look at a report like this, but I do want to make sure we're clear on this. There is one other scenario where you can have a disclaimer of opinion. Does anybody know that scenario? So that is when the auditor is not independent from the client. This will never occur for a PCOB audit because you have to be, by definition, independent from the client to be a PCOB auditor, do a public company audit. It is possible that it could occur under ASB audit. In that scenario, it's usually a pretty simple audit report. It usually just says, we were not independent from the client, therefore we cannot issue an opinion. That's basically all there is to it. Which makes you want to know, why did they do the audit in the first place? They can't get any assurance from it, but I guess some people are just kind of like saying, I kind of like to know what the audit looks like. Yeah, just like, yeah, just want to know. And with that, we're done. Have a good day.